All right, let's take a look at Chapter 11. Chapter 11 really goes with Chapter 10 because Chapter 10 is property, plant, and equipment, and Chapter 11 is the depreciation, impairment, and depletion that we may utilize to move portions of the value of an asset to the income statement. So depreciation basically is in place to allow for matching of revenue and expenses. So we would like to match the value and the utilization that we get from our assets over the period that they benefit. And so depreciation and depletion is really the basis for that. There's another topic in here called impairments. So impairments occur when we've recognized a significant event that either devalues the asset or makes the asset no longer useful to a business. And when we recognize a loss of value, either partially or totally, under generally accepted accounting principles, it's important that we recognize that loss immediately and devalue the asset or write the asset off if appropriate. So I will also look at presentation analysis of fixed assets. I'm not going to spend a lot of time on depletion. Depletion's a fairly specialized area, and not a lot of industries use depletion unless you're in a mining or forestry industry, but I'll talk about it very briefly. It's very similar to depreciation, but it's applied to natural resources as opposed to property, plant, and equipment. So when we talk about depreciation, it's essentially allocating the cost of a tangible asset to expenses in a systematic and rational manner. So those periods expected to benefit from the use of the asset. There are other methods of doing that. So for intangible assets, which we'll cover in Chapter 12, we use amortization. And for natural resources, something called depletion is used. All the methods are fairly similar, but right now we're going to focus in on depreciation. So we want to ask three basic questions. What's the depreciable base to be used? And that's essentially what we talked about last chapter. That's the cost of the asset. What's the useful life? So how long is it useful to the business? And what method of cost apportionment is best for the asset? So which depreciation method? Almost all companies use straight line depreciation, but there are other methods that we'll talk about in this particular chapter. They're generally classified as accelerated forms of depreciation. They can be some of the year's digits, they can be double declining. But as I mentioned, the vast majority of companies do use straight line depreciation for financial reporting. For tax purposes, it's a different issue, but this is not a tax course, so I'm not going to really focus in on what happens with the tax laws. So the original cost, and one thing that was really not discussed in Chapter 10, but should be noted, is if we determine the salvage value, we should reduce that. So salvage value is what I expect to get at the end of life of an asset. And in the real world, almost all companies ignore salvage value. And then estimate of service life. So how long is it going to be useful to your business? Not how long the asset life is. So I may buy a building, for example, and decide that for my business, it's going to suit its purposes for 10 years or 20 years or 30 years. The building probably has a much longer useful life, but I'm going to depreciate it over the useful life to my business. So there are a variety of different depreciation methods. For the most part, as I mentioned, straight line depreciation is used. You could use activity, which is units of production. You could use some of the year's digits, double declining. And sometimes we'll have composite depreciation on groups of assets. So that is also acceptable under generally accepted accounting principles. So here's an example of somebody who's going to use the productive life in hours. They estimate that they can get 30,000 hours out of this particular machine that they have. They have the cost, the useful life, salvage value. So they would basically take the estimate, the number of hours they use in a particular year over the 30,000, and they would then apportion that over the original cost minus the estimated salvage value to come up with the depreciation for that particular time period. Same company, same asset, but in this case, they're using straight line depreciation, and which by the way is what I believe 98% of companies use. Original cost minus the salvage value divided by the useful life. So you can see the depreciation charge is significantly different under the methods that we use. But at the end of the life, it ends up being the same. So it's just a timing issue. Or you can use decreasing. Okay, it's often called double declining, or some of the year's digits. Some of the year's digits, basically, I add up the sum of each year. So in this case, 5-year life, 5 plus 4 plus 3 plus 2 plus 1 is 15. Then the first year, it's 5 over 15, or 33%. The second year, it's 4 over 15, and so forth. And I depreciate that against the remaining value each year. Okay, so, and here's the illustration of that. Okay, and then you can have something called declining balance method, or double declining, it's often called, where basically I'm going to take twice the straight line depreciation. So first year I'll take 40%, and then the second year I'll take 40% of the net value, the net book value, and so forth. And this is what that looks like. So that's double declining. So you can see there are a variety of different ways to do depreciation. As I mentioned, in practice, almost everybody, particularly for financial reporting, uses straight line. Now, one of the things that you have to recognize is that, particularly if you're in a capital-intensive industry, that investors and creditors will be very aware of what depreciation method you're using for financial reporting. So you'll have to detail that in the footnotes. Just like we detailed in the footnotes about inventory, we'll have to detail in the footnotes about our depreciation methods, because it can have a significant impact on the earnings, as you've just seen by the different depreciation methods. So here's an illustration that you could walk through using the 4 methods that we just discussed. So give you something to practice if you'd like to. Okay. There are some special issues that come up. Group methods I've seen where we basically classify all similar asset types to have a same useful life, same depreciation method, and the composite method as well. But it really is, other than grouping assets or making a composite method, essentially you're going to utilize the same depreciation tools that we've just reviewed in the earlier section of the chapter. So on occasion, you may find that you'll have to revise your depreciation rates, and that most often happens if you decide that the useful life of the asset has changed. It might have become shorter or longer, in which case it's under general accepted accounting principles totally appropriate for you to change the estimates, but it has to be documented and it has to be accounted for in the current period and prospective period, so you don't have to restate prior periods. Okay, so we've seen this with other issues as well. So, and here's an example. So there's no correction of prior periods. There's not an error, just a change in estimate. So now I have to depreciate going forward. So I look at what my net book value is and what my extended or shortened life is, and I depreciate over the remaining time period. Okay, so there is an issue that comes up in industry, and that's this issue of impairments. So impairment is when the carrying amount of an asset is not recoverable. So that can either be partially or totally. And so what's important is that a company writes off the amount of the impairment, either partial or total, when it's recognized. So events leading to impairment, significant decrease in the fair value of an asset, or a manner in which the asset is used. So the asset may not have changed, but maybe the way that we use it in a different line of business, or it's become obsolete. A significant adverse legal factor, and a projection of forecast demonstrates continuing losses associated with an asset. So any of these things are what's called impairment. And impairment testing is required for certain categories of assets on a regular basis, and particularly for assets that we have some uncertainty about the future cash flow. So we want to continually review events for possible impairment if the review indicates impairment. And so it's a relatively complicated thing beyond the scope of this course, but basically I'm going to look at the long-term cash flow that the asset has, and if it's less than the book value, then you want to write it down to that. And if there's no future value, cash flow, then you want to write it off entirely. So the key is that there is an impairment process, impairment review, and then there's a write down immediately when that's recognized. So and if you expect to recover something, then you can recognize that. Okay, so here's an example. Okay. So depletion is much like depreciation and amortization, which we'll look at in the next chapter, but it applies to natural resources. So there's a variety of industries that are focused on natural resources and petroleum, minerals, timber, etc. And they have two main features: the complete removal of the asset and replacement of the asset only by act of nature. So depletion is simply the process of allocating the cost of the natural resources. So the first thing we have to figure out is what is the cost, right? So it's the acquisition cost, it's the exploration cost, it's the development cost, and the restoration cost. All of that goes into the depletion base. And then we're going to go through a process of depletion. And as with fixed assets, there are a variety of methods that we could use, but most often what's going to be used is the number of units extracted. Okay, that's the process that typically is used in depletion. So I make an estimate as to how many barrels of oil, how many pieces of lumber, how many minerals I can derive, and I depreciate the asset based on the extraction that I've had in a particular period. Okay, so again, total cost minus salvage value, total estimated units available. This is the depletion cost per unit. Here's an example. So, all right, so that's all I'm going to talk about with regard to depletion. Let's look at how to report and analyze property, plant, and equipment. So, because in many industries, it's a significant portion of the financial statements, we have to disclose depreciation expense for the period, balances of major assets of depreciable assets by nature and function, the accumulated depreciation, and a general description of the method or methods used in computing depreciation with respect to major class of depreciable assets. So those are the keys in terms of the footnotes. There's also analysis that's done to look at how effectively one is utilizing these key assets. So asset turnover, just like we saw with inventory turnover, it's also used for fixed assets. So one of the things that is important to investors and creditors is not just how profitable an organization is, but how efficiently and effectively it utilizes the assets that it has under its control. And so there are metrics, which again, beyond the scope of our course right now, but you will certainly progress and be looking at ratios and financial analysis and higher level courses. And this, just to put things in a little bit of context, so it gives investors and creditors some additional insight in terms of the efficiency and effectiveness of management utilizing the resources that they've been empowered to have. So All right, so that concludes everything I want to cover in chapter 11. So we're going to go on to, in the next recording, to our final chapter, which is on intangible assets.